Most investors think they get stuck because they do not have enough down payment, but that is not always the real bottleneck. A lot of investors are not short on ambition. They are using the wrong financing structure. In this video, I want to show you why serious investors can get trapped at 2 or 3 properties even when they are doing a lot of things right. And more importantly, I want to show you why the solution is not always finding a smaller deal. Sometimes the solution is understanding a better financing system. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, especially the financing structures that most investors never really get taught. Stay with me until the end because I'm going to break down why a larger multifamily deal can sometimes be more financeable than another small rental property. Most investors start the same way. They buy one property, then maybe a second, then maybe a third. And at first, the strategy feels simple. Save more, buy again, repeat. But eventually, the lender stops looking at the investor the same way. Every new mortgage adds more personal debt. Every property starts stacking against personal income. And even if the rental income is there, the residential lending system starts to tighten. This is the part that surprises investors. The issue is not always that they do not have money. It is that their borrowing capacity is being measured through the wrong lens. They are trying to build a portfolio using a system that was never really designed for portfolio growth. When investors hit that ceiling, the first instinct is usually to save more, put more money down, lower the loan amount, reduce the pressure on the file. And yes, sometimes that helps. But it does not always solve the core problem, because if the lender is still qualifying the investor based heavily on personal income, personal debt ratios, and residential mortgage rules, then adding more down payment may only delay the same issue. It does not necessarily change the system. So the real bottleneck is not always the down payment. It is the structure of the debt. And if the debt is being structured around the investor's personal borrowing capacity, there is usually a ceiling. That ceiling may show up after 2 properties, 3 properties, or 4 properties. But eventually it shows up. This is where CMHC-eligible multifamily becomes important, because the conversation starts to shift. Instead of asking only how much personal income does this investor have, the analysis starts looking much more closely at the asset, the income, the debt service, the operating structure, and the long-term performance of the building. That does not mean every deal works. It does not mean financing is automatic, but it does mean the investor is no longer looking at growth through the same residential mortgage framework, and that changes the strategy, because a qualified investor may not need to keep chasing smaller and smaller deals just to fit inside a personal lending box. They may need a deal where the financing is structured around the asset properly. That is a very different way to scale. The reason this matters is because leverage and amortization are not just financing terms. They shape the economics of the investment. If a deal can support higher leverage through the proper CMHC-eligible structure, the investor may not need to tie up as much capital upfront compared to a conventional approach. If the amortization is longer, the annual debt payments may be lower. And if the debt payments are lower, the projected cash flow can look very different. So the deal is not just being affected by the purchase price. It is being affected by the structure of the debt underneath it. This is why a larger multifamily opportunity can sometimes make more sense than another small rental. Not because bigger is automatically better, but because the financing system may be more aligned with the asset. The building has income, the underwriting has a commercial framework, and the investor is not relying only on personal mortgage capacity to move forward. Quick question for you. If you feel stuck in your portfolio right now, what feels like the bigger obstacle? Is it the down payment, the bank qualification, the cash flow, or finding the right deal? Drop it in the comments. I read through them, and it helps shape what I break down in future videos. Here's the real point. Most investors think scaling means finding more cash. But in multifamily, scaling often starts with understanding how the debt is built. A deal with weak financing can trap capital. A deal with stronger financing can create more flexibility. And when the structure is right, the investor may start to see opportunities differently. Not as, can I afford a smaller property, but as, can the right asset support the right financing structure? So the takeaway is this: if you are stuck at 2 or 3 properties, the answer may not be to simply save more and repeat the same strategy. The answer may be to change the financing system you are using. Because in CMHC-eligible multifamily investing, the down payment is only one part of the equation. The bigger question is whether the debt structure actually supports growth. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and the risks that do not always show up in the first conversation. And if there's a topic you want me to cover next, drop it in the comments. I read through them and it helps shape future videos. If you want to explore opportunities that have already been filtered through this kind of process, you'll find links below where you can join the investor list or learn more. And in the next video, we're going to take this one step further and talk about why a deal can look expensive at first until you underwrite the debt properly. Thanks for watching, and I'll see you in the next video.